Hi and welcome to Swissquote's Daily Market Talk. It's Monday, September 15th. The week starts with fresh record highs in Asian markets on the back of dovish Fed expectations, but also a growing technology appetite. The US dollar remains under pressure into this Wednesday's FOMC decision, which is expected to kick off a fresh easing cycle in the US monetary policy. Then the Bank of Canada is also expected to cut its own rates this week, along with the Fed to give support to its economy, while the Bank of England officials will likely opt for a no change when they meet this Thursday. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the new week starts on a positive note after last week's sufficiently soft inflation data from the US paved the way for a rate cut this week from the Fed. The latter, combined with rapidly deteriorating jobs market in the US, is now expected to lead to a series of rate cuts from the Fed in the coming months, the first one being scheduled for this Wednesday. So investors are ready and the markets are almost fully priced for a 25 basis point cut in US rates on Wednesday forward. The US dollar remains offered on the back of dovish Fed expectations across the board, and the US 2-year yield has rebounded from the 3.5% level last week, but the yield remains at the bottom levels of this year, and equity markets are obviously enjoying the ride, with S&P 500 hinting at a slightly positive start to the new week after having hit the 6,600 mark for the very first time in history on Friday. And sentiment across European futures is also quite encouraging this morning as well, even though the European Central Bank refrained from cutting its own interest rates last week and kind of announced that the policy easing in Europe is probably over for now, while the FTSE 100 index in the UK bounced lower from near record high levels on Friday. The Bank of England here is expected to keep its own interest rates unchanged at this week's monetary policy meeting due to a sticky inflation in the UK, while the Bank of Canada will probably lower its own interest rates this week by 25 basis points, along with the Fed, to give a further support to its economy that is being squeezed by trade pressures. As such, the diverging central bank expectations of today and the diverging central bank policies create interesting trade opportunities across the FX markets. The US dollar remains broadly offered on the back of soft and softening Federal Reserve expectations, with every piece of data pointing at a weakening economy. The euro remains bid on the back of firmer European Central Bank policy and more visibility on trade with the US, though the political shenanigans in France limit the upside potential, because not that Fitch did cut France's credit rating from AA- to A+ on Friday due to the country's inability to put a plan together to rein in the rising debt levels, a situation that will probably keep the French-German yield spread widening in the coming days, and the latter will obviously lead to further selling of the French bonds across the channel, while sterling holds its ground against a broadly weaker US dollar, but steadily loses ground against the euro. The hawkish Bank of England here looks less appetizing, to say the least, given the rising inflationary pressures in the UK into a weakening UK economy hit by tax rises and the possibility of more tax rises on the horizon to keep the UK's finances in check in a market environment where, as you probably know, investors are no more willing to finance the British debt at low levels. And compared to its DMPs, the UK's 10-year gilt yield stands at the highest levels, around 4.65% level this morning. But not that the yields have actually risen significantly since the pre-pandemic times elsewhere as well, along with higher inflation levels in DM markets, higher government spending due to the pandemic, and higher interest rates due to the higher inflation. And most of these developed market countries are having hard time controlling their debt levels today that exploded during the pandemic times and have never been really paid back. And the latter is obviously pushing capital out of the long maturity DM bonds these days, and the money seems to be flowing into commodities, into hot commodities, and gold and silver are obviously enjoying the ride. As you probably know, the geopolitical tensions and this clear divide that we see today between, well, the world countries, especially India, China versus the West, further support purchases of non-sovereign assets, especially from the EM central banks that increase their gold holdings in exchange of their US Treasury positions. As such, we see that gold is consolidating its gains near all-time high level again this morning, while silver continues to push toward its highest level since 2011. Crude oil, on the other hand, rises this morning as well on the back of weekend attacks on Russian oil facilities, and also Donald Trump is now asking his allies to stop buying energy from Russia and threatens to impose up to 100% tariffs on India and China that actually refused to stop buying the cheap Russian oil. So the latter, the rising tensions should eventually cement support near the $62 per barrel level in US crude, yet the bulls need a major political shakeup to sustainably break above that $65 per barrel psychological mark at a time when OPEC is willing to bring more oil to the market, although their capacity to do so is broadly questioned. Now, moving to Asia. The week started with weak economic data from China. Industrial production there, along with retail sales and investment growth data, all came in lower than expected by analysts, and the unemployment rate in China rose. But the bad news for China were actually perceived as being potentially good news from the markets, as weak production and weak sales data from China will eventually boost the stimulus expectations from the People's Bank of China and the Chinese government, and along with the AI appetite, keeps the Chinese equities in demand. As such, the CSI 300 index is up this morning. The Hang Seng index in Hong Kong consolidates gains near the highest levels in 4 years. CATL, which is a Chinese EV battery maker, rallied as much as 10% this morning in Hong Kong and hit a fresh record high before retreating on the back of the news that there is going to be a new energy storage plan from the Chinese government, and also on the back of a stock upgrade from JP Morgan. So broadly speaking, a gauge of Asian equities just hit a fresh record high this Monday morning, mostly boosted by the dovish Fed expectations, cheaper US dollar, and obviously growing interest in Asian technology stocks. In the sense, Alibaba extended last week's gains with a nearly 3% push this morning. BYD rose 4%, while Tencent consolidates close to its 2021 peak levels this morning. The Korean Kospi index, on the other hand, is rising exponentially these days as well, on the back of growing inflows into its technology stocks. So their national champion, SK Hynix, opened this week at a fresh record high before giving back a part of the gains, and the technology and AI-backed rally in the Asian names certainly has further room to run, given that the valuations in these Asian technology stocks remain sensibly lower than the US peers. As such, the Asian technology ETFs actually do remain a very interesting option, a very interesting way to diversify away the US technology holdings and benefit from the actual AI rally without investing in overly expensive US names. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.